Thank you for joining us at First Intuition for our Personal Tax AAT revision session. We're up to task 9 in this series of revision sessions, working our way through First Intuition mock number 1, and we have made it as far as capital gains tax, and this time reliefs and exemptions. So what's in store for us here? Let's take a look. This particular task then is going to be worth 10 marks, giving you about 15 minutes to complete it. And one of the key sticking points, I think, in this task is probably the first part, which are the rules for principal private residence relief. So we need to know the rules on PPR. We need to know how to use losses in the most tax efficient manner. And we need to be able to calculate capital gains tax once we've actually accounted for other income. So do make sure you know the rules for PPR. One of the biggest issues, strangely enough, with the PPR calculations is the counting of the number of months in each period. So don't be afraid in the exam to use your fingers if that's what you need to do. You don't want to be losing marks just because you couldn't count. So do have a proper look through that task briefing so you do know what to expect, and we give you a little bit of a reminder on what you need to be looking for. And here is the task that we're going to be working through. So we'll start off with part A, Naomi, and then we'll move on to part B, which is going to be about PPR. Okay, let's start then. Naomi sold an antique desk, and whenever I've got a capital gains question, I'm immediately thinking, is chattels involved here? But Naomi sells an antique desk for £33,200, which had originally cost £12,500. So it's a normal gains calculation. The cost and the proceeds are both greater than £6,000, so normal gains, nothing funny going on. She also had some current year losses though of £2,250, and she had some brought forward losses as well of £53,200. It wants to know what the losses will be that she can carry forward into 25-26. So I would suggest we're going to put together a working. Just going to see if I can keep that bit of information on the screen to start with. Let's do that. Okay, so proceeds from the desk then. She sold it for £33,200. It cost £12,500. So we can get an idea about the amount of gain that we're actually dealing with in the year. We've got £20,700 there as being the gain on this particular asset. So she's got a gain of £20,700 on this asset. Now what we are looking to do, of course, is legally and ethically to make sure that she pays as little tax as possible on this gain. So how are we going to achieve that? Well, the first rule about capital gains is that you take the gains in the year and you offset the losses in the year. So the first thing that I'm going to do from that gain is I'm going to say you don't have to pay tax on all of that because we have capital losses in the same tax year. So capital losses this year will be offset against the gain in this year. So 20,700 less the 2,250, 18,450. So that would be my net gain for the year. Netting off the gains and the losses in the year, that is actually now the gain in this tax year. So does she have to pay tax on that? And the answer is still no, because she is in luck. If you consider making losses in the past to be lucky, but she is in luck because she has previous year's losses. She's actually got a bucket full of losses here of £53,200. If I just continue my working over here, let's have our net gain, 18,450. and she has losses of £53,200. So I just need to work out how much of those losses I need to use against the gain that she's made in this year. And the good news is, when you are using a capital loss brought forward, you don't have to use it all. You can choose to use just some of it. So I can restrict the amount of loss that I'm going to use. And I know that she, Naomi, has an annual exempt amount of £3,000. So £3,000 of this gain is covered by an annual exemption. Pop that down there. So it means that once I have used the losses, it's the wrong place to rule off. Once I've used the losses, I want to have £3,000 of gains left. So I want my taxable gain, or the chargeable gain rather, the gain before the annual exemption. I want my chargeable gain to equal 3,000, because then I can make the use of my annual exemption and I can bring my taxable gain down to 0. So I've still got absolutely no tax to pay, but I want to make sure that I don't use more losses than I need to. So I need to use sufficient losses brought forward to turn 18,450 into a gain of 3,000. So I'm thinking 15,450. So using losses of 15,450 leaves me a gain of 3,000. The gain of 3,000 is covered by the annual exemption. So to now answer the question, how much loss is available to carry forward? She had 53,200 brought forward. And now we need to deduct 15,450 used in the year. So we end up with 37,750 as being the loss to carry forward. So that would be my answer. Lovely. Next part of the question then starts to look at PPR. And I think what we'll do with this one is we will actually just revise the topic before we launch in, because if we can't remember the rules on PPR, we're going to get nowhere fast. So let's just do that first. So I've copied the question into here just so we can have that available to us when we get to it. But for now, let's just remind ourselves of the rules. So the idea behind PPR is that if you sell your home, your principal private residence, then there is no tax to pay. But if you sell a home that wasn't your principal private residence for the entire duration that you owned it, we need to find out which part is going to be exempt from tax, which part can you claim the relief for, and which part will you pay the tax on. What will be your chargeable portion? Now, it's very simple. If somebody lives there, they live there. So we have this thing called actual occupation. And actual occupation is the period that you actually live there. So you live in the property. You sleep there, you cook there, you live there. Pretty simple. The bit that's a little bit less simple is the next part, which is called deemed occupation. And this is a period that we are going to get relief on, even though we didn't actually live there. So there's certain periods of time where we can say, we know that we didn't live there, but we'd like you to treat it as though we did. So we can receive some relief for these periods. So let's see what they are. Okay, first thing is the last 9 months. So the last 9 months before the property is sold is deemed occupation, providing, there is a bit of a caveat here, that the taxpayer lived there at some point. So providing the taxpayer lived there at some stage in the ownership of the property, you can claim the last 9 months as deemed occupation. So that's the first one. We then have another list of periods that are deemed occupation, but this next list is a list of periods that have to be preceded by and followed by a period of actual occupation. So if we have actual occupation before and after the period of absence, we can also have the following periods classified as deemed occupation. And deemed occupation is good because it means that we don't have to pay the tax on this portion, even though we didn't live there. What could be better? So actually living the property, easy. Last 9 months, assuming you lived there at some point, easy. You lived there a little bit before, you lived there a little bit after the periods of absence I'm going to show you now. You can also have them as deemed occupation. So first one, any period, so no time limit, where you are working overseas for your job. So any period working overseas due to employment, not self-employment, employment. So you've got a job. Your employer seconded you to another country for a while. You work overseas because of your employment. Then we've got slightly more limited period, but periods up to a maximum of 4 years, where you are overseas for work, but you are self-employed rather than employed. So this period, actually this period of 4 years, I have separated it here. 4 years where it was self-employed, and it's actually overseas or in the UK. So both. So maximum of 4 years where you are overseas or in the UK when you're self-employed. And of course, you are working away from home. It's not just you're self-employed and taking a holiday or taking a year off. You're self-employed and you are working. The third one is if you are required to work elsewhere in the UK. So you are working elsewhere in the UK. So you are employed, you are required to work somewhere else, and this is a maximum of 4 years. So lots of 4 years going on. So just spot the difference there. If you're employed and you're working overseas. So employed, you're overseas, any period, because you're employed. If you are employed and in the UK, they give you 4 years. So I guess the idea is that it's easier to come back to your home if you're in the UK, or maybe it's just easier to sell it and say, well, I'm going to be here for a while now, let me sell my other house. But you get 4 years if you're working in the UK as an employee. As a self-employed person, it's just 4 years wherever you are, UK or overseas. And then you have the lovely last one, which is any period that you're just away from the house for any reason. So any period, for any reason, at a maximum of 3 years. And you can use those 3 years in bits. So you could say, oh, well, I'm away for a couple of months because I went travelling. Great, you can have 2 months there. Oh yeah, then I moved in with a friend for a year. Okay, so you can have that year. Oh yeah, then I went travelling for another 6 months. Okay, you can have that 6 months. So it doesn't matter when they happen. You might have had the house for 20 years. You can have a month here and a month there over the 20 years. It's fine. It's just you've got a maximum of 3 years altogether. And when we do the calculations for this, we do it in both days, not days, we do months and years. We ignore days. In the exam, it will be full months. In real life, we'd calculate days, but exam world, we're going to focus on full months. Right, should we give it a go? Where's our information? Here we are. So let's have a look then and see what is going on. And often, as I said, the biggest problem is just the actual counting. So what I'm going to try to do here, there we go, make that slightly smaller to see if I can move that part over slightly. Okay, no, let's leave it. Yeah, there we go. Just want to move it that way a little bit. Not happening. Try that then. There we go. Because what I want to show you at the side of this is that I want to actually show you 3 columns. I want to show you the total number of months in each of these time periods. So what is the time lapse between January 10 and June 10, just as an example. I then want to put it either into a column where I would say there is either actual or deemed occupation. Doesn't matter which, because they're treated the same. So actually the taxpayer was there, or one of those exemptions apply where I deem the taxpayer to be there. And then the next one is going to be how long the period of absence was. And then, of course, in the end, the period absent and the period actual and deemed should equal the total. So that gives me a nice little double check, if you like, that I can work towards. So lived in the property from January 10 to June 10. So counting on my fingers, January, February, March, April, May, June, all within 2010. So we're talking 6 months. Lived in the property, so that's actual occupation, so 6 months and no period of absence there. From July 10 to June 15, went travelling. Now, many ways that you might have been taught to handle this. I would personally start from July and say July 10 until June 11 would be 1 year. So that would be 12 months. But he didn't come back in June 11. We went on to June 12. And then we went to June 13. And then we went to June 14. And then we went to June of 15. So by just sketching something and just not relying on my brain to do it all in my head, by putting something on paper, and I always use personally the start date and move 1 year on. So if I'm dealing with more than 1 year, I'd find the year end, if you like. So if it sets off in July, that year would come to an end in June of the following year. And then I would just move on in full years. So 1, 2, 3, 4, 5 full years, 12 months in a year, 60 months away from the property. Just went travelling. Doesn't suggest work, doesn't suggest self-employment, just travelling. So if I look at my then options, providing that he or she lived in the property both before and after the period of absence, I can have these exemptions. First 3 are all about working in some respect. The last one is any period for any reason for 3 years, as long as they lived in the property before and after. Well, they did live in the property before, and they moved back into the property after. So I can have 3 years or 36 months for any reason. I'm going to have that there. And that leaves 24 months of absence. All right. July 2015. moved back into the property. So when I get to June of 2016, that would be 1 full year of living back in the property. When I get to June of 2017, that would be a 2nd full year of living back in the property. But then from June, I don't have a full year. So this is when I then count on my fingers. So I have 2 years. And then I have from the 1st of July 2017 until December of 2017. So using my fingers, that would be 6 months. So 2 years and 6 months. 2 years is 24 months plus the 6. I'm looking at 30 months that the person was actually back in the property. So that's actually living there. Then we have a period of self-employment. From January 2018 to December of 2021. So January 2018, a whole year would take me to December of 2018. Another year would be December 19, then December 20, and then December of 2021. So that would be 4 years then. With 12 months in each year, that would be 48 months. And the rule on being self-employed and being abroad is a maximum of 4 years. So maybe the taxpayer knew that because they were actually only away for 4 years. And that is allowed because there was a period of occupation both before and after that time abroad. Pop it in here, 1st of January 22 until June of 2023. Well, let's do it in sections again. So January 22, first full year would take me through to December of 2022. So that would be 12 months. And then I've got until June of 2023. So I'll start with January 23 until June of 2023. So 6 months there. So 12 months plus 6 months, 18 months altogether of actual occupation. And if you think you can do this without using these little work-ins, that's not a problem. I just include them for those people that find that they consistently get these wrong. So living in the property, that's got to go into my actual column. And then finally moved into a second home. There's no subsequent living in the house after that because the house is sold after this period. But we're in luck because there is an exemption whereby the last 9 months of ownership are allowed irrespective of whether you move back in. So this period starts in July 23. So 1 full year would take me to June of 2024. That would be 12 months. And then another 6 months would take me from July of 24 until December of 24. So 18 months altogether. So 18 months there in total. And here, 9 months is deemed. The last 9 months. Remember the exemption. There was an exemption for the last 9 months. You didn't have to live in it afterwards. You can just have them. So let's add up then everything. So 180 months altogether of ownership, of which 147 was either living there or deemed to be living there, and 33 was absent. Okay. So what next? Well, we can use this information now to start filling in the question. total period of ownership, I've already done that one, is 180 months. And the number of months of actual and deemed residence or actual and deemed occupation, they're meaning the same thing, is 147. So I can slot that in as well. And what I sometimes find is that students get through all that hard work, like you work really hard, counting on your fingers, getting all those dates right, remembering all those rules, brilliant. Then we get to the third part, where it says the chargeable gain on the house is, and we mess it up. Because instead of giving the chargeable gain, we give the PPR figure. So take extra special care here. I'd advise you start with a pro forma. The pro forma is going to say, take the proceeds, deduct the cost to get a gain. They're asking for the chargeable gain, so that means before the annual exemption, so I don't need to factor that in. So I could start with this. Proceeds less cost would give the gain. This is the gain before the PPR. So proceeds are, let's look, 850,000. Cost is 80. Wasn't a bad investment, was it? I think I'd probably take that. So 770,000. That's again before the PPR. Then we need to calculate the PPR. Just move that little wavy line down slightly. Make a little more room. There we go, just rule off there. So then I would deduct the PPR, which would then give me my chargeable gain, the gain before the annual exemption. So how much PPR relief am I going to get? Well, the formula for that says you should take the period of actual and deemed occupation divided by the total period of ownership, multiplied by the gain. So the actual and deemed, 147. The total ownership was 180. The gain is 770. And often that is the number people, when we've calculated it, is the number that people present as the final answer and say, this is it, this is the answer, in the box, off you go. It's not the answer. It is part of the answer. This is the amount of PPR relief. It's not the amount of the gain, it's the relief. So we then get a chargeable gain of 141,167. If the question said, what is the PPR? That's the answer. It doesn't. It says, what is the gain? The gain is 141,167. And that's it, finally. That brings us to the end of that part of the question. So do practice those. Definitely worth spending a bit of time on. You're not going to get anywhere unless you actually know the rules sort of surrounding PPR. So very important that you can sort of write those out, knowing when the deemed and actual occupation periods are. So let me just slot in the remainder of the question here, so I've got a bit more room to answer it with you, and then we'll do this last part. Different taxpayer here, completely different bit of the question, so we sort of start again from fresh. Okay, so last part of the question is Denise, and Denise has chargeable gains of £40,100. Chargeable means before the annual exemption, because it was after annual exemption we call it taxable. Her other income after the personal allowance is £29,800. What will she pay in gains? Okay, first thing I'm going to do is work out the taxable gain. Let's do it down here. So the taxable gain is the amount on which she will pay tax, and it's calculated as the chargeable gain minus the annual exemption. So we've got 29,800, no, wrong one. We've got 40,100 of chargeable gains. And we've got 3,000 annual exemption. So we've got 37,100 that needs to be added in with all our other income to work out how much tax we're going to pay. So if you've attended my previous lectures in this revision course series, if you haven't, you might like to go back and do that. I talk about drawing or sketching a little bucket for these sorts of questions. So if any question on tax payable, I have a bucket approach. And in my bucket, what I do is I make a note of the higher rate, basic rate limits. So 37.7 for basic rate, and then 125,140 for higher rate. So 37.7 for basic rate. Move that down a bit. 37.7, so everything under there is basic rate. I then have a section where I pay higher rate tax, right up to 125,140, after which time I move into additional rate tax. Now I'm interested to know how much of these bandings I've already used up. So her other income after the personal allowance is 29,800. So I don't draw this to scale, but I've got other income in here of 29,800. So that part of the basic band is all taken. So when I add my gain on top of that then, because my gain is actually what we call the top slice of income, so the gain then gets added on top, and the gain is 37,100. So how much of the basic rate band is remaining? The basic rate band is capped at 37.7. I've already used up 29,800 of it on other stuff. So let's check what I've got left for the gain. 7,900. So I've got a gain of 7,900 at the basic rate. The total gain was 37,100. So that would mean the rest of that gain falls into the higher rate category. All I then need to do is consult the reference material for the rates of tax that I pay on gains. And there is a section for that. Basic is 10, higher rate is 20. So 10% there and 20% there. So the final tax payable, 790, 29,200 at 20% is 5,840. So 6,630 altogether. there we have it. So do make sure that you practice, particularly the PPR element of that question, and make sure, another tip, make sure that you are very, very clear about the difference between a chargeable gain and a taxable gain, because it would be a shame to lose out just because you forget what to do with the annual exemption. So another great question, that one. Spend a little bit longer on that one because it's just a little bit more complex. But it's also something else to pick up from these sessions, which ones are going to be the quicker questions and which ones are going to take up more of your time.